Welcome to episode 6 of The Board, How Investors Grow Their Wealth Faster. This actually came up as a question to me, and the question started off with, Arjun, I'm really struggling to get my first deposit together, and I want to know why investors can suddenly, make it look so easy going from 4, 5, 6, 7, 8, 9, 10 properties and beyond. And the big part of that is the 4+1 rule, okay? Really important. And I'll take you through that right now as to why there's a difference between going for your first and going for the ones that happen later on. And the change is dramatic. And this is a big reason why some people actually jump into the market sooner, potentially look at mortgage insurance options, or potentially look at affordable investments. It's not to say that that guarantees the activation of the 4+1 rule, but it gives you more of a chance than it does just sitting back and using cash to wait until you get that perfect deposit. So let's talk about what the 4+1 rule looks like. On the left is what we've got available when you are looking to purchase your home or investment. So this is your first property. Now it's important to note that the emotions that come with buying a home when looking at this part here. When buying a home, most people go to the bank and they have a request for their borrowing capacity, see what they can afford, and then it's actually funny because through my experience being in that situation, supporting many home buyers in the bank, I noticed that many of them request for their borrowing capacity and then want to straight away work to the maximum of that part. What that means is that, sure, they might open up the left sides here, but they won't open up the right sides, A, because they're buying a home, and then B, because they're usually maxed out to their capacity, trying to go for their first dream one, and then they wonder how difficult it becomes to invest afterwards. So let's move that to the side and come back to the 4+1. RS stands for regular savings. So it's basically the system you've created. It is how you save on a weekly, fortnightly, or monthly basis. So if you had a calendar, you could dot out exactly how much you'll have by what time, because it's just a consistent system that you've got in place. LS, this is more of your lump sum. Sometimes it's out of our control, but still something we can consider. For example, commissions, bonuses, or certain gifts on maybe occasions like birthdays or Christmas or whatever it may be. But they're basically your lump sum of funds that you get that are outside your regular system. Now, on the left side is what you're usually open to when it comes to buying that first place. And this is the limitations that actually exist, right? So when it comes to buying a home, you don't open the right side here, but also pre-buying your investment, you're stuck to these two here, regular savings and lump sums, regular savings and lump sums. Sometimes the lump sums might come in the form of gifts or anything like that, but that's another topic on its own. Okay, so now you've gotten into investing, and this is the part where investors can grow their wealth faster. And that comes because you've now opened all 4 parts here. A stands for appreciation. So appreciation can either come in the form of your asset growing up in value, or your income that is produced from your asset that's going up as well, or higher because you were on X income before and now you have an income producing asset, it's increased your income from there. Okay? So this A can actually impact your RS and LS. So from the income it might improve your regular savings, and then from the appreciation if you borrow against it, it'll increase your lump sums. Okay? And then now we look at T. T is tax. So from the tax perspective, you might have properties that have depreciation or other tax advantages, and potentially you may see yourself, if you have a higher income, or even an income in the middle, you might be seeing yourself get some money back from the government each year because you are getting those tax incentives. Okay? So now you wonder, all right, you've got your second or third property, and investors are really starting to supercharge the wealth they can grow, and that comes from these 4 here. They combine your regular savings, your appreciation, your lump sum savings, and T, the tax. Whereas when you're going for your first place, or when you're traditionally going for those homes, you get stuck because you're only having access to the left side here. And so with access to the left, that really does slow it down compared to having access to all 4. Now these 2 here are all potential, meaning you may have an asset that may not grow, or you may have a tax that policies change and you may not get the same back. But the fact that investors take that chance on these 2 is now that they've opened up the 4 rather than just having the 2. Okay, so that's the 4. Now what might be the +1? As investors start to grow their portfolio, not only do they gain confidence in their own ability to do that, but others actually start to gain confidence in it too. So you've seen perhaps people that do joint ventures, people that put money in terms of passively. So they may want to invest money for you to go fulfill their deposit. You promise them a return that's guaranteed for X years and their money back at the end of it, and then use that money to go and invest in property. Now, as your portfolio starts to build, you will catch more attention. You will have more friends and family that may want to do what you've done, but not with the same amount of risk levels. They may want you to take on those certain risks and support them with their passive money or their returns. So this is when OPM opens up, and that stands for other people's money. And you'll notice most of the times it's the investors that have built a substantial portfolio that can start to open the floodgates up in this area, whether it be from a business or whether it be from themselves personally. So yeah, that's with the 5 here. 4 plus 1, regular savings, lump sums, appreciation, tax, OPM, other people's money. That is how essentially investors can grow their wealth faster, and the difference it takes in growing your wealth from after your first few investments versus trying to go for your first. That's it from us here at InvestorKit, the experts in wealth creation, helping you take action.